Good morning, Long Island, and welcome to CMM Live. My name is Joe Campolo. I'm your host. It is a beautiful July afternoon, and we are going to be joined today. Today we have a very exciting episode. You know, our goal is to help Long Island thrive, showcasing a lot of our business leaders and a lot of our topics here on Long Island. Today we're going to talk about money, because a lot of people don't like to talk about money, and there's no better person that I like to share a conversation with about money than my good friend and my accountant, Alan Sasserath. Alan is a partner at Sasserath Zoraian, an accounting firm here on Long Island. And full disclosure, he's my accountant. He's our firm's accountant, and I'll share with you folks why. You know, Alan and I over the years know each other, have done some transactions and some deals together, either on the same side or on the opposite side. And I found Alan to be truly one of the most knowledgeable and talented accountants here on Long Island, where there's no shortage of accountants. And so I said, hey, why isn't this guy helping me out? You know, and so now he is. And Alan, thanks for joining us today. We're happy to have you here.
Yeah, thanks for having me. Thanks for that great introduction as well. I can't say enough. I love working with Campolo Middleton. Joe, like I said, thanks for having me. It's a pleasure to be here.
Well, there's a lot to talk about. There really is. But let's talk a little bit about your firm and your background, because I think it's important for folks to understand, the depth and the different types of experiences that you guys have.
Yeah.
So tell us about it.
Yeah. So our firm, I'll tell you a little bit about me first, and then I'll talk a little bit about the firm. My experiences, I started with large firms, with Ernst & Young, and then eventually to some regional firms on the island. And from there, decided that was offered the opportunity to become a partner at one of the firms, and looked at the firm and said, they're a great firm, but the reality is I want to do maybe something a little different or work a little differently, and decided to start my own practice. And when we started the practice, it was primarily domestic types of clients, U.S. closely held businesses, where maybe there was a handful of owners, and myself and my partner, Gregg Schor, my first partner, started the firm. And from there, we sort of grew up a little bit and said, you know what, we do want to specialize, have a more specialized practice. And we always have that closely held niche for Long Island-based companies. From there, we started doing some work with hedge funds. And now we do the admin for probably about 70 hedge funds, which are all over the country, not just Long Island or New York based, and even all over the world for that matter as well. And then from there, started doing some international work and really developed that into a niche, to the point where now probably a third of our business is international based business. Whether it's international based or U.S. companies going abroad, it's a third roughly hedge funds, and a third that closely held business piece. And that closely held business piece is everything from, say, a service industry to software, to wholesale and distribution. We wear a lot of different hats. We're about 25 people, so we've got the breadth to be able to wear those hats comfortably. And like you said, working on especially working with you, like starting out working on the M&A side. A big part of what we do is helping business owners understand the asset that they have, and how are they going to monetize that at some point in the future. So that M&A practice that we have as well is is tremendous, and it really falls into our wheelhouse because we started on the tax side. Both myself and my partner were in the tax departments at big firms, and now, and really brought that to the, to the closely held business, which for us, closely held business, a client in our wheelhouse might be anywhere from, say, $5 to $50 million in revenues, where they have a strong in-house person, but really need somebody to help sort of watch out for some of the bigger picture items, and that sort of thing.
Yeah, so a lot there. Let's unpack it. Let's unpack it a little bit. So let's talk about the M&A space, the mergers and acquisition space, because that's really where you and I met. And what I found, over the years is that there are a lot of accountants who either don't really understand the space that well or aren't very comfortable in that space. And a lot of businesses here on Long Island have had the same accountant, the same way they've had the same lawyer for many, many years as the business has grown. But when you get to a transaction, there's a lot of moving parts, there's a lot of things. So how did you get into that space, and what's sort of been your experience in that space, and what sort of transactions have you worked on? Let's talk about that a little bit.
Yeah, so as far as how we got into this space, like I said, we work with a number of closely held businesses over the years, and really that was my training ground, and that was my training ground at the mid-sized firms. And just to talk about that for a little bit, at those mid-sized firms, one day you're the income tax expert, the next day you're the sales tax expert, the next day it's the estate tax. So I saw a lot. And when it comes to a transaction, you've got to take those pieces and figure out how it works for the business owner. From the tax perspective, it was sort of a great entree. But one of the things where I think we excel is that we also care about the people involved. When we have a client, it's yes, it's a client, but there's a person behind that, and understanding that person and what they want and what they need. That all comes into that whole that M&A area, so that we're not just going in and reporting history. We're going in and trying to figure out, all right, so where do you want to go eventually? And the business sale isn't what happens on a day or a plan 6 months to get to that day. A lot of that starts very, so much earlier on. And I mean, it's rare that a company has a better mousetrap that's so great that they've got companies bidding for it. Normally, it's a situation of, all right, so we've got this company. Who would be the right buyer to pay the most money to the business owner? So
right. So one of the things that I really like about you and your team is, to represent business owners with their baby, their business they've had for 30 years. And a lot of times accountants, especially if you're brought in to consult on a transaction and you haven't been their accountant for 30 years, a lot of times there's not a lot of bedside manner that goes on.
Right.
And folks don't want to hear that they've been screwing up for 30 years and now they have a lot of trouble. So it does take a fair amount of compassion to unpack that and clean up a balance sheet. But on the other side, I've also been in the trenches with you moving towards a close, where you have to stand your ground and be very aggressive to get things, done. And I think that's a unique style that your firm, led by you, has. So talk about that delicate touch that you have to have with these clients.
yeah, so it's funny, and I always hear or always see you speaking about negotiations and It's not always about extracting every last dollar, but the negotiations have to work. And there might be a situation where you have to live with these people for a time in the future. So you've got to look at all of those pieces. I don't think that you can just say, like I said, that you're just trying to extract every last dollar out of a transaction. So, like I said, I mean, understanding the individuals involved, talking about the negotiations as it's going on with your team, because it's not just the attorney, it's not just the accountant. It's, the client's also very heavily involved in this whole thing. And, it's funny, I always think when it comes to negotiating, it's important. There's two things that are really important: knowing when to speak and knowing when to shut up. And I joke about that, but it's a delicate balance, and it's more human nature, or as much human nature as it is, as it is about dollars and cents.
Yeah, it's an art. It's an art, and you guys do a terrific job with it. Let's shift gears for a minute to hedge fund space. So I know your partner Gregg Schor, himself a talented accountant, sort of heads up the hedge fund space. Talk about that area. Like it's very odd, and in a good way, that a Long Island-based accounting firm would be in a hedge fund space, would be administering hedge funds. And most people don't even understand hedge funds. So
Right.
Just talk about that space a little bit and what you guys do.
Sure. So the hedge fund space is really, just like the accounting practice is headed up by myself and Lynn Montag. The hedge fund practice is headed up by Gregg Zoraian and John Zoraian. And we got started in the hedge. So initially it was myself and Gregg that were the firm's partners. Lynn came to work for us over 10 years ago at this point. With regards to the hedge funds, Gregg's brother John had tremendous experience in the hedge fund area. He was with Pete Marwick. I mentioned before I was with Ernst & Young. Really, I was with Ernst & Winnie, to date myself a little bit. But with regards to the hedge fund, so John started working with a hedge fund in the late 70s, early 80s. Grew up with the fund, without going into all the details, that grew to be $20 billion. John was the controller and then CFO and then eventually the head trader there. So he saw a lot of what went on at hedge funds. And in the early 2000s, we were starting to look for our specialties. And John was looking to get out of that rat race a little, because when you're the head trader for a $20 billion fund, if you're on vacation and there's a correction in the market, you're in your hotel room in front of a computer, and that's what you're doing. And John wanted a little less of that rat race. So a couple of his friends had told him that hedge fund administration was a growing area, or an area that he thought that we could start and grow. And what administration is so basically what happens is that you've got an investment manager that wants to trade, that enjoys the trading part of it, but doesn't want to deal as much with the investors or the accounting or the back office. So what we do is, on a monthly basis, we get information from the brokerage houses. We, looking at the documents, we know what the expenses are and should be and what should go through that hedge fund. And we record all the transactions. We run the P&Ls by the investment managers to make sure that they sign off on everything. Once they sign off, then we send the statements out to the individual investors. So the individual investors have somebody that's looking over, so a third party. We're not auditing, but we're at least getting the information from a third party and preparing the accounting so that you don't have a Bernie Madoff situation. And what happened, what was bad luck for the investors in Bernie Madoff's fund was fortuitous to us in that when we started the practice, that was probably a couple of years before the whole Bernie Madoff situation occurred. And once that occurred, then every hedge fund needed an administrator. Before that, it was sort of elective, whereas now everybody really needed to have one, so that there is some outside company looking over the books and records.
Right. So what is a hedge fund? Just tell our viewers, what is a hedge fund? People hear it and they think it's some mysterious Wall Street thing.
Yeah, it's actually fairly simple. So what a hedge fund is you'll have an entity, and in that entity, one of the partners will be the company that manages the money. You've got limited partners that invest in this fund. And the hedge fund, the documents that all limited partners understand is how that hedge fund is going to trade. So that it could be a long-short equity fund, meaning they invest in stocks, bonds, where they either buy because they think the market's going to go up, or they sell because they think the market's going to go down. It could be something like that. It could be something more complicated. But just staying with that for a second, so the investors put their money in. The investment manager trades. And assuming that there's a profit, that profit gets split part to the investment manager and the rest to the limited partners. So that, in essence, what we're doing is we're doing the accounting for all that.
But you will advise people if they're interested in a hedge fund, you will advise them and represent individuals as well who have invested in them, correct?
Correct. Yeah. So we have clients individual clients that were interested in investing in some of our hedge funds, and we'll make the introduction to the investment managers. We don't get paid a fee or anything like that. I mean, our fees from the hedge fund are based on the total assets under management. So in theory, if somebody invests, we're going to make a little bit more money, but that's not the driving force. The driving force is to do the best thing for the client, and both on the hedge fund side and the individual investor side. And we've got clients that have investments in 20, 30, 40 hedge funds, not necessarily our hedge funds, but individual clients that invest all over the board, really.
Right. So even more interesting to me, because you said you have 25 people, you have a very sophisticated practice in terms of tax, hedge funds, and international. I mean, you guys have carved out a really great practice for international-based accounting and business, transactions, really top-notch. Talk about that. How did you guys get into that? How are you growing that? How are you working that? Because I think people on Long Island should know how advanced your international practice is.
Yeah. So thanks. And so the international practice, as I mentioned, the accounting practice is run by myself and Lynn Montag. The international practice is myself, Michael O'Brien, and George Batas. So the way that we started in that is, the reality is that we stumbled upon it, and we had worked with a couple of clients here and there on the international side, and one of the things that we always say is that always said that it's dangerous to dabble. So with regards to international, we started doing work for one company. It started with 10 impats and expats, and individuals that came from Europe, come to the U.S., and we prepare their personal tax returns, maybe an equalization to make sure that they're not getting hurt by working in the U.S. versus the foreign country. And then from there, grew our knowledge base. And once we grew the knowledge base, we knew that we needed an international network to really solidify ourselves. And at the time, we were probably about 12 people, and there were a number of international networks of accounting firms that are out there. And none of the major ones wanted a 12-person firm in Long Island to be their New York firm. You know, typically they have firms all over the country. So we looked at that as an opportunity and said, we're involved with a number of the international tax groups on LinkedIn. So I put some postings up there stating exactly what we were looking for. We received responses from about 25 firms around the world, spoke with all of them, ended up with about 6 or 7 of those firms that we really clicked with. We were all had former Big Four experience, left to be able to provide our services at a more reasonable rate than a larger firm. There were a lot of synergies, and we all had some sort of an entrepreneurial spirit. So what we did was we were on the phone monthly for the first year, just to get to know each other, see, talk about how we could help each other, what we could do. And after the first year, we said, we all seem to get along. Why don't we meet? So they all came to New York the first year, and we met. There were 5 of us, and we talked about how we can grow that. The name of our group is International Tax Practitioners. There are both accountants and attorneys, tax accountants, tax attorneys in there. And the group, we sort of split, and we said, all right, so 3 of the members, why don't we concentrate on growing the group? The other 3, why don't we see how we can grow our referral base. So now we've been doing that for about 5 years. We've got about 15 countries, 12 to 15 countries that are involved with the network. We meet every year. We go to a different country. Since we started, last year was Canada. Prior year was Ireland. The year before that was the Netherlands, and this coming fall I'm going to be in Germany. And typically, when we go to Europe, we will our clients that we have in other countries and other nearby countries will go over and see them. So we've also been to Denmark and the UK and have made multiple trips to some of those countries as well over that time period. Just as the client base grows, it's important to go and see what's going on, what they're doing, how they're doing it. Like I said, and Michael O'Brien, we brought into the firm probably at this point 6 or 7 years ago, maybe even 8 years ago, and he's tremendous on the individual side. From a personal tax, estate tax, planning perspective, and compliance, he's tremendous. And then I had originally taken the corporate work on, business and corporate, and now George Bottas helps me out a lot with that. So it's a great area. It's a growing area. I always feel like on Long Island that there's an opportunity more for U.S. companies that are going abroad to, even be able to take advantage of our network, because our network, if it's somebody that a lot of the firms that in our network we've worked with already. A couple of the countries, the Netherlands and Ireland, many times. For a U.S. company going abroad, it might make sense to have their business headquartered there. And there we have really close ties. So for me to pick the phone up and call Marie Bradley in Ireland or Hendrik Van Dungen in the Netherlands, it's a great opportunity. And they're terrific to work with. I mean, I think that we work alike. Which is why we probably get along so well when we work together and with our clients and have mutual clients and many mutual clients, and the same thing goes with them. We pick the phone up and we get things done.
Yep. Last couple minutes, let's talk about the sort of economic conditions that are being sparked now, both here at home and internationally with the with the Tax and Jobs Act and tariffs and all that other stuff. What's your take on it? What's your scorecard? How do you feel it's going to impact Long Islanders? How do you feel it's going to impact the United States? What's your general sense on it?
So I feel like the as far as tariffs and that sort of thing, that something like that can always happen. The market doesn't like uncertainty, and my issue with the way that things are going are happening now is that they seem to be happening very sporadically, which I think in general hurts the markets. That being said, if you go in with your eyes open and say that there are things that can occur, and then now is as good a time as any to go, to move a business internationally. As far as the Tax Cuts and Jobs Act, I think that sort of leveled the playing field a lot from the U.S. perspective, in that the corporate tax rate in the U.S. was 34%. You'd throw in the States, maybe you're at 40%. Many of the European countries were between 20 and 30%, with a lot of them less than 25% or less. So that's a big difference. Right now, there's less of a difference. And again, I mean, you can pick your states. If there's a foreign company coming to the U.S., they can pick their state. So I mean, overall, I think that the climate to do business internationally has never been better. There are stumbling blocks. One of the stumbling blocks right now is that the Wayfair decision that just came down from the Supreme Court as well, where in the past you needed to have some sort of a physical presence in a state to be subject to sales tax. Now all you need to be, now you just have to have a certain number of sales or certain dollar amount of sales to be subject to sales tax. And I wouldn't be surprised if before long you're going to see the same thing for state income tax. Right. So like I said, I think now is a great time to expand internationally. But again, that there are always going to be hiccups along the way.
Yep, that's great. We got a break now. We'll have you back to talk about some of those other interesting tax issues at a future episode. Folks, that was Alan Sasserath, the very talented accountant from Sasserath and Zoraian, letting us know about a lot of important issues here. Thanks, Alan. He has a beautiful family as well.
Thank you,
so we appreciate you joining us.
All right, sounds great. Thank you.
Protegrity Advisors was founded to address a gap in the market, especially on Long Island, for family-run and closely held businesses when it came time for them to sell. They've spent years, sometimes decades, building up a business, and that business is typically their largest asset. But when it comes time to sell, they really didn't have the local expertise needed to effectuate a proper exit. What Protegrity Advisors does is bring the sophistication of an upper-tier investment bank to the closely held family-run business, running a process the same for any company here as we would if we were selling a publicly traded company. I've been involved with mergers and acquisitions for over 20 years, initially as an executive at companies which ended up getting acquired by Microsoft, by IBM and EMC, and also on the buy side, leading corporate development teams looking for acquisition targets. One of the many reasons that the Protegrity team is special and why we bring a competitive edge to transactions is that we've all had various roles at companies. We've been in our client's side of the table before. So we've been presidents, founders, doing anything necessary at companies. We've taken companies public. We've taken companies private. We've acted as the CFO, as the bankers, as the accountants. So when you take the collective experience at the Protegrity team, we've seen it all.
So welcome back, folks, to CMM Live. My name is Joe Campolo, your host, and we just came off a very interesting segment with Alan Sasserath, partner at Sasserath Zoraian, to talk about a lot of financial things that are going on. And now we're very happy to be joined with my good friend Gregg Schor. Gregg's the CEO of Protegrity Advisors, a wonderful mergers and acquisitions advisory firm located here on Long Island. I do serve as the chair of the Board of Advisors of Protegrity, so I know it fairly well. But there's been a lot of stuff going on, and we wanted to, to have a conversation with Gregg. You know, it's very interesting here on Long Island because folks, most folks, people who don't own a business, their largest asset is typically their home. And people are very comfortable and familiar with working with real estate brokers when they need to sell their home. But truly, a business can be a much larger asset than folks' homes. And people haven't really gotten comfortable yet on Long Island, or they're not inclined or intuitive to say, I should be working with a broker to help me sell my business. So talk about, Protegrity Advisors and why folks with businesses should be thinking along those lines.
Well, thanks, Joe. I appreciate the invitation and to appear on the show. I think we're actually changing that dynamic where people are getting more and more open business owners to using an advisor. I think the description broker carries with it sort of times more of a negative implication in terms of they're used to, a real estate broker where you may just kind of post something on a website and do very little in terms of marketing and research and actively soliciting clients. When you're selling a business, it's much more confidential. You can't have customers, employees, suppliers knowing that that you're even thinking about a sale. So I think that has a lot to do with the reluctance of a business owner to proactively seek out an advisor for a transaction. They may mention it to their accounting firm or their lawyer, or they may be receptive to an unsolicited inquiry. But in terms of proactively looking, they have that concern about confidentiality, and also it's a huge emotional leap for these companies. Typically, it's a business that was started, a long time ago, maybe even by a prior generation, and it's become a way of life. And while they, in their mind think about one day selling, to actually, kind of pull the trigger and make that decision to at least explore the possibility, it takes a lot.
So, M&A advisors here on Long Island are fairly new. I can remember over the last 20 plus years practicing, a lot of times accounting firms wanted to try and handle the negotiations, and lawyers would try and handle the negotiations. And it seems to me that, M&A advisors are the ones that are really equipped to maximize value in terms of the transactions. So talk about what Protegrity does, throughout the whole process to help make sure that value is being maximized.
Yeah, so at Protegrity, we approach the sale of a business the same way that a top-tier investment bank would. We start out by really understanding the business, the good, the bad, and the ugly, because we want to know, is now the right time to sell? Should they wait? Should they maybe make some acquisitions themselves to try and increase valuation and show that they could scale? So we really do a thorough analysis of the company itself. We do kind of an informal valuation at the beginning because we want to get a feel so that we can communicate to our clients or our prospective clients, here's what we think is a reasonable valuation range that you can expect, because you don't want to go through a whole process, get offers, and then find out that the expectations of the client really weren't in line with what market realities are. We then research, we have extensive databases and networks. We research comparable transactions to try and see, how hot or cold is the market? What are buyers looking for? What are they valuing? Is it revenue? Is it earnings? Is it growth? And so we research, thousands and thousands of transactions to see where this company may lie. We create then the marketing materials for the company. So it's typically a confidential information memorandum, which will go through the history of the company. We create a story on here's where the company came from. Here's why it's such a great opportunity for someone, but more importantly than where it came from, here's where it could go. Here's the growth opportunities, because a buyer is coming in not they want to see you demonstrate, a great trajectory in the past, but they're really buying the future, depending upon whether the type of buyer they may be holding on to it or they may be looking to sell it in a certain number of years. We do the reach out campaigns to the potential buyers confidentially. They won't find out who our client is until they sign a non-disclosure agreement. And then it's a staged release of information over time. Once they sign the non-disclosure, they get the memorandum. Then it's typically some in-person meetings, telephone calls. The next step after that is hopefully multiple letters of intent, so that our clients can make comparisons. This purchase price may be higher, but this has a better, maybe a client wants to stay on for X number of years, and with this particular purchaser, they could do that, whereas another one, they want to buy 100% and they can't stay. Maybe one is asking for more escrow, or the earnouts are unattainable. So we like to be able to have a myriad of offers for the client to review. The client will accept one. There'll typically be a no-shop period during the due diligence phase. Go through due diligence. We manage that process as well. We create the virtual data room. We coordinate with the lawyers and the accountants and wealth management providers, whoever else is involved, so that the client can focus on running their business. And then we help with the, with the negotiations. Many times, at the end of the day, every legal issue is really a business issue, so it gets handed over to the law firms, as you well know. And certain times they reach impasses because it really comes down to, some type of business decision between the seller and the buyer. So we stay involved throughout the whole process, and we can even stay involved post-transaction for the transition. So we're there from before it starts until after it ends.
Yeah, I mean, you guys really, as far as talent on Long Island, you guys have really assembled a powerhouse of talent that sits there for these Long Island businesses. There's a myriad of business brokers out there. I still never understand exactly what they do, but really it is. So talk about the team. You guys have grown. You got beautiful new space. Talk about the team. Talk about, all the talent that Protegrity is able to bring to a transaction.
Yeah, so every deal has its own deal team. So it's typically made up of a research analyst. We have a director of financial modeling and valuations who's fantastic, who's probably the best with spreadsheets I've ever seen in my life. We sell to public companies. He'll sit on a conference call with 8 accountants from Ernst & Young. He'll explain to them in a nice way why their assumption is incorrect. He'll point them to a line in the spreadsheet, and his computer won't even be open. Then we have a lead advisor, someone who's been in the industry before. Typically for at least 20 years, who has experience in that sector, and then I round out the deal team. So it's not just one person; it's a whole group, and then we have marketing, IT, admin, other support that we pull in as needed.
Yeah, it's great. And most of the advisors that you guys have there that I've worked with have all been former operators or sold businesses themselves. So it's not a bunch of eggheads sitting around trying to, it's guys who have rolled up their sleeves and done the deals.
Well, we think that's a major differentiator for us because we have been on all sides of transactions, and I'll use myself as an example. I've been Deputy General Counsel, Director European Operations, SVP Corporate Development, SVP Human Resources for companies that ended up getting acquired by Microsoft, by IBM, by EMC. I've also made acquisitions for companies, leading deal teams from that perspective. In addition, I don't typically admit this, but I started out as a lawyer, so I bring that perspective. So myself and the rest of the deal team, we've been on the buy side, we've been on the sell side, we've been lawyers on transactions, we've been accountants on transactions, so we've really seen it from all different perspectives.
Yeah, and it works. I mean, the most significant transactions that are happening here on Long Island, you guys are always at the forefront of it. Let's talk a little bit about the advanced diligence offering that you guys have. I could have, Alan alluded to this on the prior segment here, and I could have lamented forever. Is, you go into a new company, a family-owned company, and of course there's some hair on there. But what I try to tell folks is, just like when you're selling your house, if you just paint the kitchen, redo the bathrooms, do a little bit of landscaping, the impressions are always different. So talk about advanced diligence and how important it is for business owners to have their house in order.
It's critically important, not only in terms of the valuation that you get, but also the time that the deal takes. You know, time is an enemy when you make the decision to sell. Anything can happen in the interim. It's also going to impact the escrow. The more confidence a buyer has in a company, the lower the escrow amount and the lesser the escrow period will be. So, you know, the way we approach it is, you know, you don't want to be cleaning house under the magnifying glass of a potential buyer. You want to do it when you're not under any pressure. It gives you latitude to clean things up more effectively. It reduces the risk that any employees or customers or vendors are going to find out that you're going through a transaction. And, you know, many times we'll go into a company because typically they're not running it for when they want to sell it. They're running it to do the best they can now. But many companies don't have employment agreements in place, especially with salespeople who are going to be key to the post-transaction world and the buyer. Intellectual property they may not have, have all tied up. Many times, the contracts with key customers expired 10 years ago, and they've just been doing business ever since. And that may work day to day, but in the context of a potential new buyer coming in, you need that contract in place. So there's many things that a company can do to get themselves ready and put themselves in a much better position when you're not under pressure.
Yeah, I think that's right. One of the biggest mistakes that I've seen business owners is overestimating their own worth and underestimating the worth of their salespeople and their key employees. And when it comes time to sell, buyers are going to be making sure that those salespeople are locked up, and it turns into a little bit of a mess. We talked, again, because I think a lot of people have experience with selling or buying a house, and not a lot of people have experience with selling or buying a business. So one of the things that is easily obtainable by somebody looking to sell their house or buy a house is how much do the houses cost in this neighborhood, because it's very readily public information. Buying and selling a business, because of confidentiality, because there is no reporting requirements with public companies, you can't really get that information. So what are the different ways that you guys use to help value a business and to help business owners understand how they should be looking at their business in terms of value?
Well, the majority of transactions, unless it's a hot tech company where it's usually a multiple of revenue, it's usually a multiple of the adjusted earnings. So you take the earnings and we normalize them. So if a business owner is pulling out $500,000 a year, and if that person would be replaced, you'd be paying the replacement $150,000 a year, then that difference, that extra $350,000 would go towards what we call the adjusted EBITDA, earnings before interest, taxes, and depreciation. And that takes on very, very great significance, because if the deal valuation, if the multiple is 6x, meaning 6 times the adjusted earnings, now it's 350,000 times 6, so it adds another couple of $1 million to a transaction. So approaching the valuations and how we get the research is critical. So we have databases that we look at. The issue with the database, or the challenge that anyone who doesn't have the right experience will have to deal with, is most of the transactions where you can get the details are significantly larger. They're in the hundreds of millions or billions. So you have to extrapolate from that. You also don't know, even when there are smaller transactions, did that include earnout? Was there escrow? Was there consulting agreements built in? So we're able to filter through all of that based upon our experience and come up with what would be comparable numbers. We also have extensive networks with private equity firms, with family offices, with accounting firms, where we can check in with them and see what they're valuing similar companies, and specifically what transactions they've done. And because of those relationships, we get that information. They may not tell us exactly who the particular company was, but we can get that type of analytics, which is tremendously helpful.
Yeah, so the challenge always on Long Island is there's a lot of family-held businesses, and I always say that, maybe I should have been a psychiatrist instead of a lawyer, because family businesses are difficult. But what advice could you give owners of businesses now that are looking to sell, maybe in the future, but not today, in terms of how they can prepare themselves, not just legally and financially, but also emotionally. I mean, it's a very difficult process. Talk about that a little bit.
Yeah, you know, they have to have some idea of what they would like to do post-transaction. If their business is their whole life, they're going to have a very difficult time letting go. So they really have to, are they at the point in their life where they're ready for a change? And a lot of times it's pushed by a certain level of aggravation that pushes them to say, I'm ready. Either I've reached a certain age, or I have grandchildren, or I'm tired of the traffic or the weather, and I need to do something different. And then they also, we have them think about, would they be interested in selling 100% of their business? They should be thinking about, do they only want to sell 51%? Because in our transactions, the buyer's going to want a majority. In many instances, they want the selling owner to have some skin in the game moving forward. It only makes sense for the seller to do that if there's going to be another exit down the road. If they're getting acquired by a strategic, keeping equity there may or may not ever be a second liquidity event. But if it's a private equity firm or a family office or a search fund, then there will be. So keeping some equity and having an active role, if that's something they would be interested in. Many times the owners say, I'd love to get out of the day-to-day. It would be great to keep the strategic relationships, look for acquisitions to make, do some travel for the company, do those things. So they have to kind of mentally prepare a couple of years ahead of time and start thinking about what is it that I would want to do when I make that decision to sell.
Yeah, it's challenging, especially in terms of the earnouts. So talk about earnouts. Talk about how the typical deals you're seeing are coming out now.
Right. Now, earnout is a great tool if properly applied, because what it'll do is bridge a gap. So, we discussed earlier, there's the historical financials, and then there's the projections moving forward. A buyer is really going to be interested if the projections moving forward are attractive and growth is being showed. But if you don't hit those growth projections, then a buyer is going to want to hold you accountable. So they're willing to pay on past performance at closing. They're less willing to pay on future performance, which is understandable. From the seller perspective, once I give up majority control, I lose a lot of the impact I may have over the business. So they may not run it the same way. They may not devote the resources necessary. So you really have to come up with a formula that strikes the right balance, that really rewards the owner for hitting those objectives and for future growth, and doesn't penalize them for things that are out of their control. So there's usually always an earnout perspective component of a transaction. We position it with our clients. We're going to fight as hard as we can, and they'll be involved in the process in terms of the earnout formula, but they have to be comfortable with the sale price. Let's assume you don't get any of it. We want them to be 100% comfortable that the price that we got them is still good enough, and the earnout is just bonus on top of it, and that's how we approach earnouts.
Yeah, cash at close is important for them to understand that cash at close might be all that happens, so they have to be comfortable with that. Without violating, obviously, any confidentiality or anything, talk about some of the types of transactions, the industries, some of the things that you guys are involved in, past closings, what's going on now. Give the audience a sense of the types of industries that are hot right now.
Yeah, we characterize ourselves as industry agnostic, and we're involved in deals in all types of industries, in manufacturing, in retail, in healthcare, technology, distribution. We just closed last week a healthcare transaction where we sold an 8-location medical practice to a private equity firm, which several years ago would have been unheard of. Many doctors are, selling. They're frustrated with the industry, and they're kind of, I don't want to say taking the easy way out, but they're selling to hospitals so that they could just become an employee, and now they don't have to worry about the back office. Our clients are very entrepreneurial. They saw a really attractive growth platform that they've built over the years, and we were actually able to identify a private equity firm that's characterized as social impact. So yes, they want to make a profit, but their investors also want them to have a positive impact on the community, and that was really nice for us to be able to be part of and make a transaction like that happen.
Yeah. So, as far as manufacturing, one of the things that's here on Long Island, the manufacturing community, is changing and becoming much more diverse. So the same way, what I'm finding, and I'm interested to hear your comments on it, the same way I'm seeing, several years ago, a home healthcare, home infusion company was bought by a private equity firm that was looking to get into that space. Now, healthcare providers are being bought by private equity firms. Manufacturers are being bought by private equity firms. And here we have an interesting shift on Long Island where all these organic, family-owned, grown businesses, we now see private equity firms coming in, and acquiring it. Should these business owners be afraid of private equity? You hear all these horror stories. They get all nervous about it. Talk about that. What's been your experience working with these private equity groups?
There's all different types, and this is just a generalization, but it's not the Gordon Gekko type private equity firm that people may think of. The private equity firms actually want the businesses to grow. They want the owners and the employees to be happy because they want everyone's interests to be aligned, because in order for the private equity firm to make money, the company's going to have to sell at a higher valuation down the road than what they acquired it for. So if they were to buy a company and terminate employees and strip it down just to pull out profits, now what's it going to be worth 3, 5, 7 years from now? So the private equity firms that we do deals with, just extremely professional. Most of them have been business owners themselves, so they've also been on different sides of the table, and they get it. And it's actually been a very, very positive experience. And whereas private equity firms, originally they were just doing the billion-dollar deals, now there's private equity firms of all sizes with all different areas of specialization, and they may be looking themselves to sell it in a certain number of years to a larger private equity firm. So everyone's interests are really aligned, and especially when the seller gets to keep some equity in the business moving forward. Typically, the owner will get a board seat, some type of employment or consulting agreement, and the majority of the private equity firms want to keep the owner for, at minimum, some period of transition time. They want to see a strong management team. They're not there to gut a company.
Yeah, and that's really important that people understand, the experience that you guys have, both in dealing with private equity firms, and family-owned businesses, because I think that's the wave here on Long Island. I think private equity firms are going to be acquiring a lot of these businesses, and they've been so afraid to deal with them. And, the important issue is durability. So Alan touched on this, and I think it's incredibly important. Unlike selling a house where you close and you're never going to talk to the person again that you bought it from, they're going to be on their own. Most owners are going to be asked to be staying on for a little while. There's going to be an earn-out component. So there has to be this durability of the relationship. There has to be a cohesiveness. And that can't be relegated to attorneys and accountants, because we're terrible at making sure that there's durability. So talk about that challenge, right? So here you have, this daunting task of trying to make sure that these two parties, both of whom want a best deal from each other, are going to be able to get a deal that's win-win for both of them and can move forward. And incredibly important service that I think you guys do. So talk about that a little bit.
Yeah, I mean, I view us as kind of the quarterback for making sure the client is the owner of the team or the head coach, and the other service providers are the other coaches. But we're the quarterback, coordinating between everything and making it happen. And sometimes there's a dose of tough love with the client if they have unrealistic expectations in terms of what their compensation should be moving forward, what the valuation should be. So, when we're talking with the private equity firm, we're, 100% advocating for the client, even if we feel that maybe they're asking for things that, are really not practical or not market. We'll still do our best to achieve it. But we also have to, give kind of that dose of tough love to the business owner, and there's typically, there's going to be, one or more crises, during a transaction where everybody says, you know what, maybe I don't want to do this, but we actually know that they do, or we wouldn't have gotten to that point. And there's just highs and lows, and we try and coach them ahead of time to expect that they are going to, we are going to hit bumps in the road, but here's the reasons why. this transaction makes sense for you, for your family. Same thing with the private equity firm. And just, really sometimes being a diplomat, couching things, rephrasing things, maybe, not communicating a message directly from the private equity firm to the owner, but being, honest and accurate, but putting a context on it that won't be, inflammatory or, perceived because it's their business. You don't want them taking it personally and then overreacting, which wouldn't be in their best interest.
Yeah, and you guys are the best in the business at keeping those situations
Thank you,
calm.
Joe.
I mean, you really are, because people who haven't gone through the process don't understand that you're in the middle of a deal, you have a business owner that's getting millions of dollars, maybe tens of millions of dollars for your business, and they want to blow a deal up because they're not getting, an extra week's vacation or something like that. At that point, you just want to jump off the building, but you really got to keep that situation calm and moving forward. And you guys really
That's
are.
exactly the scenario we had on this last transaction,
Yeah,
as
it's
you
just
know.
a very tough situation. And folks that don't do it don't understand the issues that, the issues that come up. We have about a minute left. International work, right? So a lot of international companies are looking to expand here in the U.S. You have a lot of experience internationally. How do you see that playing out for, both for, the United States, New York, and Protegrity in terms of making themselves attractive to international buyers?
Yeah, I mean, we get contacted all the time by international strategics and private equity firms who are looking to have a platform company in the U.S., whereas other, U.S.-based, they may already have a platform. International ones typically don't, and those are the ones that that we're in touch with. They see especially Long Island, New York area as really a great place for them to gain a foothold into the United States. And based on my, kind of prior roles, have very extensive international relationships, especially with European private equity, family office, venture capital. So I see that being a really strong growth area in the future, having these international companies acquire Long Island based and keeping them here. That's a big thing for us. We don't want to see the clients get acquired and then operations get moved somewhere outside of the Long Island area. We really want to see it stay and grow and then make more hires locally.
Right, that's great. So, folks, we have to take a wrap here. We were joined today with Gregg Schor, President and CEO of Protegrity Advisors. Really, really huge talent here. If you're thinking of selling your business, there's nobody better than Protegrity Advisors to turn to. Gregg, thanks for joining us.
Thank you, Joe.